Hello, my name is Tobin Adams and I'm a mortgage broker. This video is designed for first-time home buyers. I'm going to explain some topics and some terms that I believe that every borrower should understand before they take out a mortgage. Alright, let's get started. Mortgage insurance is one of the things I think that a lot of people get confused about. And so before I'm going to go into the details of it, I want to explain the concept behind it. So when an investor is going to purchase your loan in the secondary market, they don't know you personally. This is not a relative. You're not going to be borrowing money from someone that you know. You, the borrower, are just like a series of data points. And since it's not someone that that's going to be you're getting the mortgage from, so they're not thinking, oh, you the borrower, I know this person's a good person, they're gonna pay me back, I'm not worried about it. What they think of is the flip of it. They think, okay, what is the worst case scenario? And I'll explain what the worst case scenario is. During the underwriting process, the underwriter looks at the borrower, and the borrower, he's got good credit, he's got stable income, he's got some savings, and so the underwriter approves the mortgage, and they close on the mortgage, and the borrower moves into his new home, and he's really happy, but he's thinking, oh man, wouldn't it be nice if I had some new furniture? So he goes out, gets a new credit card, and buys all this furniture. Then he's looking around. He's like, you know what? I think if I would, maybe I want to build a pool or do some repair work on the house. So he takes all the money out of his home, out of his bank, and he spends it fixing up his house. And so finally, everything looks great. Sunday night, he's so happy. It's his dream home. Goes to bed on Sunday, wakes up on Monday, walks into work, gets laid off. Turns out there was something wrong at the company he was completely unaware of. So immediately, without any forewarning, he doesn't have an income. But also on part of that, because maybe let's say the economy is not doing as well, and his specific job, there's just not a lot of jobs out there, so he can't find a new job. So now he's got all of this credit card debt. He's spent all the money that's in his savings, and he can't find a new job. Well, he keeps looking, months go by, can't get a new job. Eventually, the lender has to foreclose on it. The borrower gets so upset that he knows that the next day the sheriff's coming to kick him out of his house. He's going to get foreclosed on, and so he spray paints on the walls. He's angry, and he leaves the home in a very, very bad state. And so the investor is looking at this as like, oh man, I've got to, we got to clean this up. He's left all this stuff behind. We got to clean it out. We got to hire someone to clean it up. Then they need to sell it as quickly as possible, so they sell it at auction. And in this worst case scenario, where everything kind of goes against the lender, the investor here, there's this magic number that comes out, and from experience, they know that they're going to get 80% of the value of their home back. So even if things go worst case, they will be able to sell that home for 80% of the value that it was originally appraised at when they closed on the loan. And so what it comes in, so that's right. So an investor will say, okay, if you want to take out a mortgage, well, then you need to put 20% down. So that way, in this worst case scenario, you've only taken out your LTV on your home is only 80%. And so when I sell that home at auction, I'll get back the 80% and I'll be okay. But then some people came along and they said, well, what about people that don't have the 20%? What about them? And so they came up, with this concept of mortgage insurance. So if you're going to take out a conventional loan, and maybe you've only got 5% for down payment at closing, well, then the lender is going to ask you to take out mortgage insurance, and this mortgage insurance is designed to protect the investor that's going to purchase your loan in this worst case scenario. But the thing that you need to remember about it as the borrower is that every month that you're paying that mortgage insurance, you don't benefit from it. that mortgage insurance is going to go to the lender if things go bad for you. So it is. I always discuss this with my borrowers that if it's at all possible, see if you can't get 20% down. That way you're not paying for this mortgage insurance, or as close to it as possible. And then the great thing about it on conventional loans is that as soon as your LTV has now dropped just over the course of a few years, you're paying off your mortgage. If it gets down to 78%, then that mortgage insurance that you're paying will automatically go away. But also, as you, the borrower and buyer of the home, if let's say the value of the home has appreciated, plus you've paid off some of the principal, that if it gets down to 80%, you can send in a request, and then they can drop the mortgage insurance, so that way you're not paying for it. So this concept, this magic 80 number that I like to refer to it as, this is also built into your FHA, VA, and USDA. They're going to ask for either a mortgage insurance or a funding fee, but that this concept is built into all of these loan types. So regardless of what type of loan you're going to get, this concept is in there. So I just want to make sure that everyone's understands this and how it is so beneficial for you to have that 20% down when you go to purchase your home. Okay, let's go to the next one. As you can see from the slide, the conventional loans, they generally going to have a little bit of a higher minimum FICO, and you can't have as much debt to it, but you generally are going to get better rates with a conventional, and part of it is these funding fees that you don't have. So I put up some information on the four types. One thing I do want to point out that the minimum FICO, there are alternatives to this, and you can actually have less, for example, on the FHA than the 580. But those are kind of different scenarios. Just kind of consider this as kind of a starting point for you when you go check your own FICO score, just so you kind of have a sense of where you're at as you're getting started looking at the different loan types that you might take out for your mortgage. The next topic I want to talk about is the difference between APR and your interest rate. I think everyone understands it's kind of straightforward what the interest rate is, but what APR is, it's taking into consideration your closing cost, incorporating that with the interest rate, so you've got one number. And when you are going out shopping for mortgage, and let's say you talk to a mortgage broker, and then you go to maybe a bank and one of the online mortgage companies, and when you get your loan estimate, on page 3 of the loan estimate is going to be the APR. And that to me is the best way to really compare loans, to know which one are you getting the best rate for, the best price. Because in this example here, I've got 3 different loans. They're all for $300,000 loan amount for 30-year terms. But if you were just looking at the information in the yellow, it might be difficult to know, hey, is the one with 3.5 interest rate and a $10,000 closing cost, is that better or worse than, for example, the 3.75 with a $600 closing cost? And so what I've put up here is 3 examples where, in this case, all 3 of these loans are really equal. It really depends on your scenario. Do you not have very much money for closing costs? Maybe have you kind of just struggled just to get that down payment? Or do you have some extra and just simply would prefer a lower monthly payment over the course of your loan? And one thing I want to point out also is that when you are dealing with your broker, many times they're going to offer you, once you narrow it down to, let's say in this case, you're going to get a conventional, and they might offer you these 3 different choices. The way the math works out, the broker, the lender, they get paid the exact same. Their profit does not change regardless of these 3 loan loans because the APR is the same. And so this is why they're able to do it. It doesn't affect their profit. So you really just need to decide what's best for you, the borrower. Fixed versus ARM. No, I think the fixed rate everyone kind of understands, and the ARM loans kind of got a bad rap about 15 years ago during the Great Recession and the financial collapse. But actually, ARMs can be actually very, very good. If you, in general, the starting rate that you're going to get on an ARM is going to be less than what you would get on a fixed rate. So, for example, let's say you have taken a job and you're in a new location, new city, and you know that you're going to be there for 5 years or less. Then it would make sense for you to take out maybe a 5.1 ARM or a 7.1 ARM, because you know that you were going to sell that home and move. Or also, if you know that you know that you're going to refinance, sometime in the next 5 or 7 years, then this is good because your rate is actually the best rate you're going to get. Is very likely it's going to be with this ARM. The stages of mortgage origination: when you first have your conversation with your mortgage broker, very likely the first thing that they're going to want to do is it's a pre-qual. They will run your credit. It's a soft pull. It won't affect your credit score down the road, and that's just to get a sense of where you're at, and so they can kind of give you ballpark of what type of how much you could qualify for a loan. And in this current market, which is really a seller's market, I would say you pretty much have to have this. So that way, when you go in and you're talking to the homeowner or the realtor, and you're that way you are projecting that, yes, I'm serious about this. I'm qualified. I make enough that I can afford this home. Because with all the bids that people are putting out these days, you really almost have to have it in this seller's market. If you do decide to go forward, you're going to fill out the ERLA. It's the loan application. You're going to do this online, and this is when your broker is going to do a hard pull on your credit, and you're going to get pre-approval for the very specific of the house, the exact amount. Your broker is going to give you a loan estimate. And this is the loan estimate is great because it's standardized. There's regulations. They all look the same. So that way, when you shop around for rates, it's really good to look at the loan estimates from each of the companies or banks that you get. You're going to get one from, and what like I mentioned before, on page 3 is where the APR is, and that's really, in my opinion, the best way to compare one lender from another. If you once you decide you're like, okay, I want to go ahead and go forward this, then you're gonna give them the intent to proceed. The lender is going to lock in your rate for a specified time, maybe 60 days, maybe 45 days, depending on your situation. This is the one time where you're probably going to have to give you're going to give your credit card, and you're going to pay for the appraisal. In current market, there's a bit of a shortage on appraisals, so they generally want to get that started as soon as possible. Then you're going to be dealing with the loan processor. And loan processor is going to be communicating with you, asking you for a variety of different forms and some information. Once the processor believes that he's got all the information he needs, he'll send in your loan to the underwriter. The underwriter is going to take a look at it. And this is the point where the underwriter might come back with some conditions. Maybe, for example, there was a large deposit in your bank a couple months ago. They might want to see, hey, where's this money coming from? Or maybe there's some more information that they need before they're going to go ahead and approve it. Then after you would supply that information, it's going to go back to the underwriter. Then the underwriter will go through it, give it a final approval, and then you're clear to close. At which point, then you're going to arrange. They'll arrange the closing with you, quite possibly at a title company, and then you're going to go in. You're going to sign a series of documents depending on which state you're in, and then you close. The loan estimate is a great form. It is standardized. Every lender, regardless of a bank, online lender, mortgage broker, you're going to get a loan estimate, and that's going to be laid out like this. It's going to have some basic information on the front page. The second page, it's going to break down all of your closing costs, so you can see uh, in detail where it's coming from and how much you're going to have at closing. And then on page 3 is where you're going to see the APR. One thing that is important to note is that when you later on, when you go to close, you'll get another form. It's a closing disclosure. It looks somewhat like this. What you want to see, what you should see, is that there's no material changes between the loan estimate and the closing disclosure. If all of a sudden some of these fees have gone up significantly, you really want to talk to your broker or your loan originator for some explanations, because if they've done it correctly and you yourself have not made any material changes, then the information on the loan estimate and the closing disclosure, they should be pretty similar. All right, the next topic I'm going to talk about, it goes into detail or about how what the process is, not from the borrower's point of view, but really from the lender and the investor's point of view. So one thing that it took me a very long time to really kind of wrap my head around it, but basically what you as the borrower are doing when you go in and sign your promise to pay note in closing, what you are really doing is you're selling a bond, and this bond is your mortgage. The lender then is going to buy that from you, and what they do is they're going to give you a check. It gets wired that ends up going to the homeowner, to pay for your home. That lender then there's a few different processes, a few different ways that this can happen. I'm only going to talk about one of them, just so that you get the concept. But just want to let you know that there is a different alternative than the one I'm about to explain. But what happens with a lot of lenders, what they do is, like days after you close on the loan, that lender is going to sell that loan to one of the GSEs. If it's a conventional loan, then they might sell it to Fannie or Freddie. And if it's a government loan, so that's an FHA, VA, or USDA, then they're going to sell it to Ginnie Mae. The GSE is then going to turn around, bundle a series of mortgages together, and sell those as a mortgage-backed security in the secondary market to investors. These are institutional investors. These are maybe pension funds, insurance companies, that deal with large sums of money. They're going to purchase these mortgage-backed securities. And at first, if a borrower, you're like, well, what? I don't understand. Why are you selling my loan right after I took it out? There's something wrong. And the important thing, I want you, the borrower, to understand that this is a good thing. This is a very, very good thing. The alternative of this, and which is why I've got the poster for It's a Wonderful Life, the alternative of it was, if you go back in time, back into the 30s or 40s, 1930s, 1940s, well, if you wanted to take out a mortgage, you'd have to go to your local savings and loan or bank to take out your mortgage. And, well, one, if maybe they didn't have enough money, then you might not be able to get a mortgage. Secondly, if you are in Phoenix, if you went in to take out a mortgage, you might get a rate that might be very different than the person in Fort Lauderdale. With everything else being the same, you guys might get different rates. Plus, and in all probability, both your rates would be significantly higher than this current system. The system of the GSEs basically guaranteeing these mortgages and then bundling together in a mortgage-backed security, which is the connection between this institutional investor and you, the borrower. It's efficient and it drives down costs because there's lots of competition. So one thing that it's one of the things that you're going to sign at closing. It's where you agree for them to sell the mortgage, and I want you to know that this is a very, very good thing for you, the borrower. It's a win-win. Everyone from the borrower to the lender to the GSE to the investors, everyone benefits from this current system. And the last topic that I'm going to talk about has to do with servicing. So in this process where your mortgage is going to get sold shortly after you close on your loan, it's one of a few things can happen. One, like let's say it is a large bank, then that bank might retain servicing and they'll service your loan for you. Or maybe if it's a medium-sized or small-sized lender, in addition to selling that mortgage to one of the GSEs, they might also sell the servicing rights with what's called a co-issue partner. And so shortly after you close on your loan, you might get what's called a goodbye letter letting you know that the servicing has been switched. And I bring this up because a lot of borrowers don't realize this. And also, you can ask if when you go in to take out your mortgage, you can ask your broker, say, hey, look, who's going to service my loan? And maybe it's the case that the wholesale lender that they're dealing with is going to retain it, or maybe they'll say, oh, well, it's probably going to get sold. You can ask that there in all probability it's a short list of servicing companies that's going to service your loan. So you can ask, and they probably don't get asked this a lot, but you can find out, and it is possible to say, hey, if they gave you a list of, let's say, 5 different servicing companies and banks that they might go to, well, maybe perhaps you already have a checking account at one of those, and you can actually ask and say, hey, look, is it possible to make sure that my servicing goes to this bank, because that's where I've got my checking account at? So nothing bad will happen for you to ask, and it's not a guarantee that you can dictate where it's going to go, but it is part of the conversation. That wraps up this video. I hope you liked it. If you want more videos from this series, please subscribe. Thank you for watching, and have a nice day.